Good morning, ladies and gentlemen, and welcome to Meridian's 2015 full-year results announcement. We've all had a lot of time to actually consider the material in the pack, so we'll try to keep our comments to around about 30 minutes, and then we will take questions. If we could only make one statement to summarise the year, I suppose it would be how delighted the board and management is that we've now completed the 2-year prospectus forecast period, having exceeded all key metrics in both years. Furthermore, we have also exceeded the previous year's financial results. Paul, is the screen going to keep up? Okay, thank you. Operating earnings, or EBITDAF, was up 6% on last year, or $33 million at $618 million, which was 5% up on the prospectus forecast. The key movements in the year-on-year performance were a $9 million improvement in the New Zealand energy margin, with a 4% increase in retail contracted sales, more than offsetting a 1% reduction in retail pricing, and a $21 million increase in the international energy margin as the Mount Mercer wind farm contributed to the result. It was pleasing to see operating earnings only increase by 1% during the year. Excluding 2014's residual IPO expenses, operating expenses did increase with an expanding Powershop Australia and the costs of running the new Mill Creek and Mount Mercer wind farms. Paul will comment a little bit more about operating costs later. The only other metric that I'll comment on is the free cash flow number. It is a natural segue into the next topic of dividends. The definition we have here is that used for the calculation of dividends as set out in the prospectus. In making this calculation, we've taken our underlying NPAT and backed out depreciation and the standard $65 million for stay-in-business CapEx. On this basis, free cash flow at $398 million was up $22 million, or 6% on last year. At the interim results, we announced a change in dividend policy to the effect that the company would look to pay out between 75% and 90% of free cash flow on average over time. Based on the free cash flow of $398 million, the full ordinary dividend for the year will be 83% of this number, or 12.88 cents per share, a 17% improvement on last year and 12% more than forecast in the prospectus. An interim of 4.8 cents per share was paid, leaving 8.08 cents per share to be declared as the final dividend. This will be 55% imputed and will be paid on the 15th of October with a record date of 30 September. The company will also pay a final special dividend that has two components: part from asset sales and other one-offs, and another as part of our capital management program. During the year, we continued our drive to become more capital efficient and sold a number of farms that had been held for now shelved projects, and also the ARC metering business. The gain on sale of these, together with some other one-offs, has allowed us to make $38.8 million, or 1.51 cents per share, available for incorporation in a special dividend. Now to the more complex component of the special dividend, which of course is around capital management. The board announced its intention in February to initiate a capital management program at this results announcement, assuming Tiwai Point did not provide us with a termination notice on the 1st of July, trading conditions for the company were satisfactory, and there were no major growth initiatives requiring capital. The intention being that, subject to the ongoing caveats already mentioned, the board would look to commence a distribution of up to $625 million to shareholders over 5 years. As is well known, the Tiwai Point smelter owner chose to sign a variation to the existing electricity agreement. The company is actually trading within the expectations of management and board, and there's currently no significant growth opportunity in contemplation. And as a result, the board is in a position to commence the implementation of a capital management program. In terms of the method of achieving a capital return, both a share buyback and a special dividend have been considered. In considering a share buyback, the board has to consider the interests of all shareholders, and in their opinion, this means that both selling and holding shareholders must be better off from the program. In making a decision, the board has first considered a buyback and believes at current prices, which in the period from the Tiwai Point decision to last Monday have averaged $2.27 per share on a volume-weighted average price basis, there is little probability of a meaningful 12-month buyback program being substantially completed at an average price equal to or below the value of the company's shares, utilising a valuation based around the current average consensus estimates from a number of New Zealand market analysts. That consensus, can I say, is current consensus, not 12-month forward forecasts. While valuations can be a fickle thing, the board can only rely on valuations by fully informed market professionals at the time of the decision, and to willingly pay a higher price is to the ultimate detriment of remaining shareholders. Accordingly, there will not be a share buyback program at this point, and the board has resolved to commence the capital management program with a payment of $62.5 million to shareholders, or 2.44 cents per share, which will be added to the special dividend. This means a total special dividend of 3.95 cents per share will be paid on the same date as the ordinary dividend. No imputations will be attached. The issue of capital management will be reviewed formally by the board every 6 months, but should circumstances demand it, the board may consider the issue at any time. And while a special dividend has been used at this point, the board wishes to make it clear that it is not wedded to any particular method of achieving its aims. Finally, on this slide, we're delighted that returns over the year have remained strong for our shareholders. Distributions pertaining to the 2015 financial year total 18.23 cents per share, which as at Monday's share price of $2.19 represents a gross return of 10.2%. Total shareholder return for the year, assuming the second instalment had actually been paid at the beginning of the year, which of course is a very conservative assumption, was 36%. And since listing on the same basis, in October 2013, it has been 71%. At a macro level, it has been a significant year. On the political stage, the threat of a total restructuring of the market-based model, as proposed under the New Zealand Power model, was averted. While on the other side of the Tasman, we have been disappointed with the approach that has been taken by the Abbott government to the review of the renewable energy target and its attitude to renewables overall, particularly Mr Abbott's very clear personal antipathy to wind farms. A new target was agreed after 18 months of political posturing, which, together with the delay, has done significant damage to investor confidence, and the government's commitment to the longevity of the scheme is less than convincing. I think the other points on the slide will be commented on further through the presentation. Turn to operational highlights. New Zealand generation was at an all-time high when adjusted for the sale of the Tekapo assets in 2011 at 13,332 gigawatt hours, with wind volumes up 14% with the contribution from the new Mill Creek wind farm. And average wholesale prices were up 13% at $68 a megawatt hour. From a hydro perspective, we had the now familiar late summer dry spell. This is the fourth summer in a row that we have had lower than average inflows during this period. The period was well managed, and it was interesting to note that spot prices did not reflect the dry conditions being experienced in most catchments, with prices through March and April averaging only $84 a megawatt hour. While ICP or customer numbers for retail declined a very small 0.1%, the gigawatt hours sold increased 3.7% to 5,967. This represented an 8% increase for residential and small and medium business customers, although there was a 1% decrease in average price in this segment. Overall, we consider this a very good result, given the levels of competition in the market. Corporate sale volumes decreased by nearly 3%, and the average sale price by 2% as old contracts rolled off. During the year, our asset management team was tested with a discovery in March 2014 of degradation in the coolers of some transformers at Manapuri. From the time of discovery through to the commissioning of the first new transformer was 10 months, which, given the manufacturer's lead times and the environmental sensitivity of operating within a World Heritage National, came with an opportunity cost to the business. However, on the positive side, it underscored the competence and commitment we have in the Meridian team to deal with unexpected events. Health and safety. A huge amount of work has taken place over the year to totally review our safety, cultural attitudes and systems to ensure that we are compliant with the new Health and Safety Reform Bill once it comes into force. Progress was reviewed by our external auditor at the end of the financial year with an overall very positive result. The total recordable injury frequency rate, or TRIFR, for employees reduced by 44% for the year, but our key concern remains the performance of contractors on our sites, where performance, while improved, is still at stubbornly high numbers. We are committed to getting this down. New Zealand market. With compound growth in aggregate demand over the last 10 years having averaged 0.2%, it was positive for the industry as a whole to have growth at 3% for the year. But with all economic indicators suggesting slowing economic growth, particularly in rural areas, we remain cautious as to whether this will continue. However, the issue du jour is not so much what is happening on the demand side, but what is happening on the supply side. With the recent announcement of thermal plant retirements, since March this year, we have seen the announcement of 3 proposed thermal closures by Mighty River Power, Genesis and Contact Energy, totalling over 1,000 megawatts. While some withdrawal of marginal thermal plants was anticipated, we have been surprised at the extent and timing of these announcements. These withdrawals, if they do occur, would suggest that, all things being equal, the timing of the next investment in power generation would need to come forward to around 2019. It is difficult to make a call as to where this is likely to occur, but it could well be that at least one of the recent announcements may be revisited once parties have fully evaluated the effect of Monday's announcement by Contact Energy. There are a number of potential solutions if these closures come to pass, including wind, geothermal and gas opportunities, and we are already looking at possibilities. But of course there's also a demand side response, and people need to remember that the Tiwai Point smelter retains the right to terminate its electricity contract upon 12 months' notice and could serve such a notice on the 1st of July 2017, which adds another factor and some complexity to decision making. In the retail market, the level of competition remained intense and nothing's going to change there. The Australian market. Market conditions in Australia are not conducive, in our view, to investment in new plant at this point by Meridian. Aggregate demand for grid-based electricity in the eastern seaboard states, or NEM, has continued to fall, and as previously stated, the Australian government's attitude to the renewables industry and the commitment to moving from a carbon-intensive generation system to a renewable one does not inspire confidence with investors. In this environment, and with a dearth of credible parties willing to sign up on long-term offtake agreements, it is hard to see a lot of opportunities that would be of interest to Meridian in the short term. We have looked at approximately 100 opportunities, both the purchase of existing assets and development options over the last year, but none are compelling. TY point. On the 3rd of August, we announced a variation to the smelter's electricity agreement. This has been the subject of recent media coverage ad nauseam, so there's probably very little to add. However, it has to be noted that Pacific Aluminium, the Rio Tinto subsidiary that controls the smelter owner, has not resolved from its intention to sell all its Australasian smelter assets. So in the circumstances, we are realistic that what we have achieved is probably only an extension of the earliest possible termination date until 1 January 2018, albeit that Meridian should, all other things being equal, do materially better in a financial sense in calendar 2017, as it achieves a more market-related return on the marginal 172 megawatts that were freed up as a result of the 2013 pre-IPO negotiations. I have no doubt that Pacific Aluminium will be back for another chat prior to 1 January 2017, the first date it could provide 12 months' notice of termination. However, with the announcement of the intended closure of thermal plant over the last 2 weeks, it is difficult to envisage a scenario where there would be any compelling argument to consider any reduction in an already low price. Transmission pricing. Here we go again. We've had people working on this for over a decade, but there is light at the end of the tunnel, and we are happy to see the Electricity Authority's commitment to sorting this out by the end of this financial year. And while there's been some financial comment on impacts in some areas, the EA's revised numbers that were out 3 weeks ago show that the price increases in Northland and the West Coast are about 1/3 of what was originally assumed. Meridian and others have also submitted for changes to the allocation between industrial and residential, which will reduce these impacts even further. It is also important to remember that moving to a fairer basis of charging would mean lower prices for a number of South Island consumers, because they would not be paying for some major North Island assets that they don't use or benefit from, a fact that gets conveniently ignored. Given this subject is so arcane and the impact for consumers far lower than people first thought, we are hopeful that politics won't play a huge part in the decision, and hopefully this time next year we're talking about the solution and no longer the process. Meridian Retail. Paul will talk about Power Shop. This is about our core brand. Retail had a good year with EBITDAF up 17% when adjusted for the sale of Arc Innovations, our metering company. Despite overall prices being down a bit, average prices were down 1% in residential SME and the agri segment and 2% in corporate. Overall revenue was up on higher overall sales volumes in residential and SME, including irrigation, which grew by 8%. It was also a year of very pleasing operational small improvements, which ensured we continue the journey to be more efficient, and it was pleasing to see an increase in the customer retention rate and some pricing anomalies tidied up, including adjusting prices for solar feed-in tariffs. We expect to see ongoing benefits from this work in the current year. So now I'll hand over to Paul.
Thanks, Mark. Within our retail segment, we've also seen some significant developments in our PowerShop business. And PowerShop continues to lead the way in customer satisfaction, and this is what underpins the expansion into other geographies. This has meant work this year industrialising some parts of the PowerShop application that weren't originally set up for a much larger number of customers. That's more or less done now. And beyond Australia, we are pursuing a potential license opportunity in the Northern Hemisphere, which is looking pretty promising at this stage. In New Zealand, although we've only seen a 2% increase in customer numbers across the year, we've seen a 10% increase in volumes, reflecting improvements that we've been making to the service offering to business customers. In Australia, we've positioned ourselves around 4 distinct points of difference. First, control and convenience around billing, account access, payment frequency, and energy use information. Second, leveraging our renewable credentials, and that's a much bigger point of difference in Australia as compared to here. And it's one that's enabled us to top Greenpeace's list of greenest retailers and access a number of partnerships that just aren't available to our competitors there. Thirdly, we are pricing to new customers and incumbent customers in exactly the same way, fair pricing if you like, and the large Australian players generally prefer to operate a differential pricing regime so that they're effectively penalising loyal customers. And lastly, we are providing a level of New Zealand style service which really, compared to the woeful service which is on offer in Australia, is actually a distinguishing factor. This has enabled growth across a good range of sales channels, and last week we put on 900 customers as an example. But the competition are clearly not sitting on their hands, so we need to remain agile. I'm just going to cover off now some of the financials. Mark's already talked to you around the logic behind this year's dividend. So this slide sets out some of the detail behind the numbers, particularly in respect of imputation credits. As Mark explained, the final dividend is made up of 3 elements: the ordinary dividend of 8.08 cents per share, 1.51 cents from cash generative one-off items below EBITDAF, and 2.44 being the first tranche of our capital management plan. Now, as you're aware, we imputed the interim ordinary and special dividends both at the rate of 100%, and in the process we emptied Meridian's imputation credit account in advance of the second instalment receipt, which was a tax discontinuity event that would have cleared the account to zero anyway. This means that the final ordinary dividend has been imputed at a lower rate of 55%, taking full year imputation of ordinary dividends to 72%, which is in line with what we promised in our prospectus, but obviously over a smaller number in that prospectus. Going forward, we would expect to be able to impute ordinary dividends in the 70 to 90% range. Turning to financial performance that underpins our dividend payment, you'll see the positive movement across almost all our key metrics. Now, there's a lot of detail for you to look at in the appendices to this presentation, along with the new format, clearer and shorter financial statements, which were in the annual report released this morning. So I'm just going to take you through some of the highlights in the numbers and let you digest the detail at your leisure. There are a couple of one-off impacts that improved our EBITDAF, 5 million of insurance proceeds and 8 million of IPO costs that were not repeated this year. Excluding these, we saw a 20 million increase in like-for-like performance. This was primarily driven by a 30 million lift in energy margin over last year, 21 million of it in Australia and 9 million here in New Zealand. The New Zealand lift reflected higher contracted sales volumes, both in retail, which Mark has commented on, and wholesale with higher CFD sales. And despite the issues at Manapuri, higher generation volumes also reduced the level of acquired generation required. These gains were obviously partially offset by the cost of supplying the extra load, but also by a reduction in net earnings from the virtual asset swaps given the reduced inter-island price separation during the year. Australian energy margin included an uplift of 13 million in generation revenue and with a full year of earnings from Mount Mercer wind farm, and a lift of 8 million in margin after metering and lines costs from PowerShop. We also saw reduced transmission costs on the final cost outcomes from the recent DC upgrades, although these are likely to rise somewhat this year. Offsetting these positive impacts was a reduction in non-core other income following the sale of ARC and farm properties. Turning to operating costs, now overall these were flat year on year, but once the impact of the IPO costs last year are excluded, we saw an increase of 9 million. Costs in New Zealand actually didn't increase despite the maintenance costs associated with our new wind farm at Mill Creek and the additional cost of competition in retail. In Australia, we saw the first year of Mount Mercer maintenance and the cost of PowerShop expansion. If we exclude the cost of the continued expansion of PowerShop Australia, that business has already exceeded its break-even point. On the capital front, we saw the very last spend associated with the two recent wind farm builds, and stay-in-business capex was at 61 million. That's in line with the expected average of 65 million per annum that sits behind our dividend policy. Now, we don't normally dwell on the stuff that sits below EBITDAF in the numbers, but there are a few significant items that had an impact on our net profit after tax that I think it's worth commenting on. Mark's already mentioned the successful sale of ARC and most of the remaining land assets, which gave us a gain of 19 million. On the negative side, the long period of uncertainty in Australia around the renewable energy target, the subsequent reduction in that target, and importantly, the abolition of carbon pricing, which impacts the period after the renewable energy target is in place, resulted in an impairment of 38 million to asset carrying values in Australia. This applied almost entirely to the Mount Miller wind farm, which was purchased in 2009, a time when views on the Australian market were very different and you had a very different regime in place. Whilst we paid cash tax of $96 million in the year, we saw two positive accounting tax movements. We got final confirmation through an Australian tax office ruling that the sale of MacArthur was not subject to capital gains tax. This enabled us to release the 28 million we'd been providing for this potential cost. In addition, the IRD have now agreed that powerhouse structures that effectively act as part of our plant and machinery are depreciable assets, and the benefit of this change will flow through over the next few decades. The rest of this slide speaks for itself, with depreciation up on new wind investment and non-cash fair value movements down a bit on the fall in the forward interest rate curve. So I'll now just hand back to Mark for his concluding remarks before questions.
Thank you, Paul. I think it would be fair to say that the announcements of Genesis and Contact over the last 2 weeks will focus the whole industry on what a post-Otahu and a Huntley Rankine units world might look like, and what, for each gentailer, is the most beneficial supply or demand side solution to a tightening market. We've already started considering what the optimal solutions might be for Meridian, and there are some interesting alternatives that we are already considering. At an operational level, we'll be looking to continue the improvement in our retail operations to ensure we deliver better customer experiences. However, we anticipate both the New Zealand and Australian markets remaining highly competitive. We've also indicated that there's been quite wide interest shown in the PowerShop operating model offshore, and we are currently investigating whether franchise-type arrangements are viable with one large Northern Hemisphere retailer. It's something that we hope to establish, whether it's a go or not, this financial year. And as always, we'll remain focused on delivering the best results we can to our shareholders. That said, we will not be providing financial forecasts now that the prospectus period has come to an end, but we will be making further enhancements to our monthly operating disclosure to enable analysts and others to make reasonable estimates of our progress through the year. With that, thank you, and I will open it up to questions, starting here in Wellington from from the floor, and can anybody who wants to ask a question use a microphone so that our friends watching by video can hear, and then we'll pass it on to people who aren't with us. Andrew.
Good morning. So the first question I have, I guess, is just around the buyback versus special dividend, and to what level of consideration, I guess, the buyback has the key advantage of being more tax efficient. Can you sort of have a bit of commentary around that from the board's perspective?
Yes, it does, but I mean, in the board's view, any buyback has to be fair to both selling and remaining shareholders. And at the current share price, I mean, it was a view that we would not be able to fill a substantial buyback program at current valuation. And as I said, I've already had a comment that the consensus valuation is 247. Well, it's not. I mean, we're not going to use 12-month forward forecasts, which are based on a whole bunch of assumptions. We're going to use analysts' current valuations. So, in the board's view, it was inappropriate at this point to depart on a share buyback. But Andrew, I just reiterate that point that I made during my presentation, and that is that the board is not wedded to any particular method of achieving a buyback. We'll look at it on a 6-monthly basis formally, and if the circumstances require, I mean, it might look at it on an ad hoc basis.
Okay, thanks. And the second question I had, I guess, was around dry year cover in 2019 and beyond, and your views sort of on that, sort of if you can expand a little bit more perhaps, and capacity cover as well.
Well, I think there's been comment already in the media that perhaps Genesis might reconsider its decision. We aren't jumping to any conclusions at all. There are a wide range of possible alternatives, including obviously what might happen on the demand side, which is going to make some decisions a little bit more complex. But we think that is probably, we'd be very surprised if potential gas solutions don't come to the fore relatively quickly. What they might be, we don't know, but I mean, we do know the Todds are always keen to build peakers. Genesis could reconsider its decision, and Dennis Barnes has made it clear he's prepared to expand Aharoa. Storage is required, and I don't think he also said that he wouldn't look at building more capacity if that was needed. So I think the key point, Andrew, is that I'm absolutely sure that the market is going to come up with solutions. We've got quite some time till 2019. It's probably about a 30-month build program for a gas plant. So over the next year, we're sure that some solutions are going to be delivered. Hopefully everybody doesn't jump in and build something. Any other questions here in Wellington? Neville.
Thanks, Mark. I was really looking offshore, and wonder if you could give it a flavour about the split between the new wind farm costs in Australia versus the power shop costs, and give us some kind of view about what you think the forward look on that should be.
When you say the wind farm cost, you mean on a unit cost basis versus New Zealand, or?
Just based on the segmentals, so, you know, the total operating costs there have gone up, you know, labour and other 15 and 17 million from 2+2.
Yep.
Obviously some of that is operating cost of the wind farm, and some of that's power shop. It'd be good to get a flavour for split and how we should think about that going forward.
You're going to give them a split?
The increase of 13, is it? Sorry, what's the increase? The increase is 9? Well, I'll tell you what, I'll go away and give you what the split of the increase is, because there's a chunk of it which is Mercer and a chunk of it which is Power Shop. Power Shop's cost base is dominated by the acquisition cost, because the actual cost, there are 3 cost portions. A very lean team sitting in Melbourne, then there's the cost of operating the call centre and normal sort of day-to-day piece, and then there's the acquisition cost. So it's dominated by that, but we'll go and table something out for you rather than me make something up right here and now.
Yeah.
Perfect, thanks.
Also the cost this year, obviously Neil are moving into New South Wales in Power Shop, but Paul can give you a better breakdown of that.
Thank you.
All right, so we move to people who are watching on video who may have questions.
And as a reminder to those dialing on the telephone, you need to press 0 followed by and wait for your name to be announced. Once again, that is 0 followed by 1.
Okay. I think we're getting away relatively scot-free from our viewers. That's fantastic. We better close this quickly. All right, thank you very much, everybody, for coming along, and those who are here with us. I mean, I hope you all stay for a bite of lunch. Thank you very much.
Did nobody...